As Mark obviously and most of you know, we're in our DNA a credit shop. So we tend to look at the credit markets as an indicator of where we are in the economic cycle, because credit investors tend to be, no offense, a little bit more deep dive as it relates to the economic picture of companies, and really scrutinizing of where businesses are, from a fundamental perspective versus just predicting EPS versus consensus estimates. And so, I look at the credit markets as a warning sign, just generically, and I'm not saying that our perspective on the credit markets is pointing us towards a negative outlook for 2018, but there are certainly elements of the credit markets that we're following very closely that may have implications in the years ahead as it relates to a real turn in the economic cycle. I think we're all of the agreement that there's going to be general policy, removal of a policy accommodation, monetary policy perspective, which is certainly going to push the front end of the curve higher. A lot of what happens with the back end of the curve is going to be contingent upon what happened from a flows perspective out of places like Europe and Japan relative to the US, and a lot of what goes on with inflation and growth outlook. So we do believe that we're likely to see a rise in the 10-year over the course of the next 12 months. We put that somewhere in the mid-threes by the end of 2018, which produces somewhere between a 0 and a negative 2% return on 10-year treasuries. From an asset class perspective, in terms of credit markets that we focus on, we think the bank loan market, given that it's a floating rate asset class, given the default rate environment is likely to remain benign over the next 12 months, is going to produce a nice coupon, plus a little bit of spread tightening return over that period. Look at LIBOR today is pushing 150. We could see that, 250 by the end of next year very easily. That with, sort of high threes of spread income above that, you could put you at that 5 to 6% total return for floating rate bank loan assets in 2018. And then finally, high yield bonds. Again, I think certainly a much more exposed from a duration and interest risk perspective. I also think from a relative fund flows basis versus having permanent locked up capital like CLOs that are the technical bid behind the bank loan market, the high yield market's much more dependent upon global flows from Europe, from Asia, from places looking for yield, and that market has certainly got extraordinarily tight. Looking at relative value, broadly speaking, across fixed income categories, one thing I would just point out here is, we talked about this in May, I would reiterate this today, U.S. CLO assets still remain relatively attractive as a derivative exposure to floating rate bank loan assets. We still continue to think that that's an attractive play. We've gotten incrementally rotated into more defensive names, higher quality, lower duration, higher interest rate or coupon to mitigate some of the potential volatility we may see in those markets, but nevertheless relatively attractive. Conversely, I would point out European CLO market has gotten extraordinarily tight, largely based on sort of the perversion of spreads and yields that the ECB has created through some of their aggressive bond buying exercise. Always the question we're asking ourselves, where are we in the credit cycle? Valuations are extraordinarily rich. We're at levels we saw in 2014, which was the post-crisis tights. We've not gotten back to the levels we saw in 2006, 2007, pre the 08 financial crisis. But arguably, if you look at nominal yields for the asset class, they're extraordinarily tight. And at some point, especially liability-driven investors are nominal yield investors. And so while spreads may not be at those tight levels, certainly on an overall yield basis, we're trading extraordinarily tight for below investment grade credit. The market's nearly 2 times the size it was in 2008. It's massive. The access to credit markets, the access to capital, the massive amounts of liquidity, the chase or seeking of yield that investors have had globally have led to a massive upsizing of the bank loan and the high yield asset class. You can see high yield's nearly 2 times where it was in 2007, and the loan market's 1.3 times. What does that cause? That's caused a move down in credit quality. So I think people have been more aggressive with financings that they put in place, and that creates potential problems when we get into the next turn of the cycle.